Welcome to episode 20 of the Making Money Simple podcast. This one is going to be slightly different because we're also recording it on video. So if you'd rather watch this on YouTube, go over to the YouTube channel. But of course, it's still on Apple, Spotify, all the usual audio platforms. We're going to be talking about global investing today. And I'm joined by Nick from Nick JM on YouTube. Nick, how are you doing today, mate? Thank you for joining me.
I'm good. We're recording on the 27th of December, so I think we've probably both eaten our body weights in turkey and chocolate. So it's that weird time between Christmas and New Year, but no, I'm all good, man.
Yeah, that sounds good. I was also going to say, actually, good reminder that this podcast will probably be coming out early January. So hope everyone has had a good Christmas and a good New Year. Going forward, I'm going to be trying to upload a podcast every couple of weeks. But this one is quite a highly requested one, or a question I get quite common is, why do I use global funds? I use the FTSE Global All Cap. Nick also invests into global funds, but a different global fund. So in this podcast episode, we're essentially going to be going through our investing strategies, the global funds we use, pros and cons, and then sort of go down the rabbit hole of why we use global funds rather than other country funds like the UK or the US. So hopefully it's helpful. Any questions, you can let us know after you've listened to the podcast. But the first question for you, Nick, is what ultimately, I guess, is your investment approach in summary?
Oh,
How
good
long have you got?
question. Yeah, this might sound a little bit odd for somebody who, talks about investing. I've got a philosophy that I'm not that bright, which sounds a bit interesting. Um, the way I see the market is the investings, you've got two very different styles. You either believe you've got a massive brain and you can pick the very best stocks, you can see the future and all that sort of stuff. So you can go down the rabbit hole of trying to play the game of investing, which I'm sure we'll talk about later. Or you can have a far more strict back approach of going, I want to participate in the market for all the benefits it might give. But I don't necessarily want to pretend that I'm maybe smarter than everyone else. So I fall into the camp of going, I think investing is really, really good for me, but I don't want to go down the rabbit hole of picking individual stocks. So I think that's
Yeah.
that's me in a nutshell.
I think that's honestly because I feel like a lot of people, particularly when they first start investing, think that it's quite easy to pick the next hot stock. And I think what we're talking about here ultimately is the passive versus active investing debate. And both of us favor using index funds that track the market rather than, spending, probably wasting time trying to pick the next hot stock or pick the next ETF that for a country or a sector that's going to outperform, I guess, the rest of the market. But I think the fact that you're self-aware that you can't beat the market probably saves you a lot of pain, because rather than spending time researching stocks trying to guess what is going to do best, you simply just use a global index fund. So I guess going on then to the global index fund, what made you choose that approach rather than rather than using any sort of other investment, whether it be an individual stock or a country ETF or index fund?
This I've got a metaphor, and there's nothing like it in the rest of the world. So imagine if you're running a race, okay, and you're lined up on the line with 100 different other people, and you want to finish the race first. A bit like everybody investing, everyone wants to get the best return.
Yeah.
We're all going to be there battling it out. Some people are going to, when you pick an individual stock, some people are going to do better than others. Somebody's going to have the best return, and there's going to be people that have the worst return, potentially negative. Investing kind of globally, having a perfectly diverse portfolio, you're basically guaranteeing yourself to come fifth out of 100 people per se. All the research says that if you go down that approach, you're going to have one of the very best returns in the market. You definitely won't come first, second, third, or fourth, but you're definitely probably going to come fifth.
Yeah.
So that means you're protecting yourself from coming 80th, 95th, 100th. Basically, you're not going to protect yourself from losing money because you don't know the outcome of the markets in the future, but you're basically locking in the fact you're definitely going to finish, say, fifth out of 100, and you're putting no effort in, which is mind-blowing.
Big thing, isn't it?
There's nothing like it in the world where by you doing nothing, you're going to beat 95% of people.
Yeah.
I can't get my head around it, and I can't believe how many people try and scrap the top four places when actually it's very, very likely that you're going to underperform the broader markets.
Yeah.
I can't get my head around it, if I'm honest.
Investing is probably the only thing where being average is pretty amazing, because if you're an average person and you're using, say, a global index fund and compounding, your money at 5, 6, 7, 8%, whatever it is, year after year, you're literally, as you mentioned, going to outperform 95% of individual investors, of hedge funds, of active funds, everyone trying to pick stocks to beat the market. And as you say, you look at like Olympians, heart surgeons, all these people put in hundreds of hours of work because they need to for their jobs. But you look at managers trying to pick the market, trying to beat the market, put in hundreds of hours, and ultimately 95% of them will underperform the market. It is pretty mind blowing when you think about it. And I think if you realize that, and then you're also sort of self-aware to keep your ego in check and realize you can't beat the market, then I guess naturally it comes to using index funds. And then ultimately, if you want the simplest approach and most diverse approach, as you mentioned, to be perfectly diverse across the world, then a global index fund is literally the only investment that you need.
Yeah, it's spot on. Exactly that.
So we sort of touched on, I guess, but what would you probably say are the main pros and cons of index funds? I guess we sort of have just sort of gone through it there, but to summarize.
Um, the point. Um, Let me start with the con. Actually, it's boring. It is. It is really, really boring. That you can't. There's no real stretch outside the core concept. There's no strategy to it. You're not really going to see the wild swings, ups and downs. It's nothing that you're going to show off to your mates. Like, well, Ryan, us two down at the pub, Ryan, look, I've got 5% return over last year. It's not really that exciting. And that's what I think what most struggle with in terms of the con. Other than that, I think that's probably the biggest con, that it's just boring.
Yeah. The only other
Um,
con probably would be you can't beat the market. But as you mentioned already, 95% of people can't beat the market over the long term. So
yeah,
it's not really a
yeah,
con. I guess it is technically a con, but it becomes a pro when you realize that not beating the market and being like self-aware of not being able to do that probably works in your favor over the long term.
yeah. You're not going to be an overnight millionaire by a long shot. Yeah, in terms of the pros, reliable, diversified. You're guaranteeing yourselves the ups and downs at the same time, and I think we're going to talk about it later in terms of different regions versus global and all those sorts of things. You're really protecting yourself from a lot of the negatives that come with stock picking. Yeah, so on one side, you're not going to become an overnight millionaire, but you're not going to be an overnight bust, which can and does happen. There are companies, look at Alibaba at the moment. People have put vast amounts of money in big companies,
Mm.
and okay, they've not collapsed, but people have lost a lot of money. Where that's basically impossible, unless the world is literally ending. It's impossible for global indexes to collapse, to go to zero, which is maybe something we'll talk about later.
Yeah, and when I was doing some sort of research into how the global economy performed when I was writing my new ebook, the global economy, when you look at like a global index compared to other individual country indexes, it's never the best performer, as you mentioned, but it's also never the worst performer. So even though US at the moment is like essentially the top performer of a country in the world, it wasn't in the noughties. It wasn't in a couple of decades in the 1900s. You look at Japan, and of like Japan was made up 45% of the global stock market in 80s and 90s. Everyone thought Japan was the future, and now it's gone from making up 45% to just 8%. So imagine if you'd bet on the sort of flavor of the month, the best country, rather than the global economy, you would have, yeah, essentially the other areas of the global economy have grown a lot quicker than Japan now. And that, I guess, sort of shows, as you mentioned, because it's perfectly weighted, it's diversified by using the global index fund, there's almost no worry or no stress. And the only way it wouldn't work out well is if there's like a zombie apocalypse or a meteor hits the earth. And at that point, we'd all be living off of rice and beans anyway, rather than looking at our Vanguard stocks and shares ISA.
Yeah.
So
Yeah, when Apple, Amazon, Netflix, is Berkshire Hathaway all goes to zero, we're going to be hunting for rabbits more than anything else. But no, it's kind of, you brought up some really good points there. Where I'm 31, so I'm horrifically old compared to you, Ryan. But
oh, hardly.
a lot of your listeners won't have been around in those time periods. They'll only have ever known the US doing incredibly well,
Mm,
and they'll think, oh, that's what it's going to be for the future. Don't get me wrong, I think the US will continue to do well in the future, like many countries around the world, but things do change, and they will change. There
Yeah.
will be, there's strong arguments for why the UK might do well in the future, or why Africa is going to be the new place. And I can remember it was all about the brick
Oh yeah, I
economies.
remember learning about that in
So what was that?
school.
Brazil, Russia, India,
In China.
China. I think that was it. It was just four, wasn't it? I
Yeah, I
think.
remember learning about
It,
in business GCSE. I think.
yeah, yeah, yeah. It, look, it comes around. Japan, what you just said about Japan, completely right. That is, if you had just invested in Japan, you would have done terribly over the last 20 years. But it's something that I talk about a lot, especially when it comes to interest rates. But that's a completely different other conversation.
Yeah.
So yeah, they're the real reasons why global is best in my
Yeah,
eyes.
and I think actually before we get onto our specific global funds that we use to sort of go down this rabbit hole a bit more, when I was sort of looking at that data, looking at the US for example, around 100 years ago, it only made up I think it was about 25% of the global stock market, and then essentially between now and then over 100 years, it's gone from making up 25%. The high was about 65%, the low was 15%, and now it's up to about 58% again. So you can see over 100 years how it essentially fluctuated between 15% and 65%, which, if you're investing into a single country, you're probably going to be investing, if you're in your 20s or 30s for 50 or 60 years. So to see, that shift over time, which no one can predict in advance, I think really is the power of global index funds, because even though, as you say, you're not going to become, if you bet on solely on Tesla or you bet solely on the US, you might get higher returns from the global index fund, but at the same time, you might not. And that's why I guess the simplicity and ease of using the global index fund, that no one can predict the future. I think, that's just a huge benefit for me.
Yeah, I think when you talk about geography specifically, I think the one thing I always say is, what happens if somebody drops, you know what China and the US are like. If China drops 100 nuclear bombs on the US and wipes them out per se, or you could use any sort of geography, what happens then?
mm,
You're not diversifying yourself away from other things that might be outside of their control. So you talked a lot about them performing well because of economic conditions and all those things, but there are things that happen outside of economics. There's policy changes, political. You're seeing a lot with the Chinese stocks at the moment. Alibaba we talked about, and Tencent, and what the Chinese government is saying they can and can't do, and how that's really restricting what they're doing. The same thing can happen elsewhere. We've just been through Brexit ourselves, and
yeah,
who knows what the consequences might be, good or bad. And I'm not going down that rabbit hole, but you can't. These things are unforeseen and unpredictable, and I think it'd be naive to think that one geography is definitely going to do good in the long term, because weird things do and will happen in the future.
yeah, no, definitely agree. And I think that's a really good sort of introduction to why we use global index funds, and also digging a bit deeper, essentially, even more so why we use global funds, and sort of comparing them to, I guess, individual country funds. The next question then, and is what people are probably quite interested in. We're talking about investing globally, using global index funds.
Mm.
What global index fund or ETF do you use personally then, Nick, in your own investments? I know you obviously
So
do
I,
Vanguard
oh,
portfolio updates every month on your channel, which obviously brilliant, by the way, and people should
it
watch.
is.
But yeah, what fund do you use personally?
God, I must have said this following line a gazillion times. So over the last 4 years, I'm just into my fifth year of investing. So I've used the FTSE All World UCITS ETF, for a very long mouthful of a title, but it goes by the ticker symbol VWRL. So it's one of Vanguard's, I would say, pretty flagship global ETFs, alongside a few others that I'm sure we're going to talk about. And it's the one that I decided to pick for a few reasons, because they all do have little nuances in terms of why one's different to another, which I'm sure we're going to talk about.
Yeah.
But yeah, the FTSE All World is my baby as such.
So yeah, so I guess digging deeper into that, what made you? I guess you want to give a quick overview of what the fund does, and then why you chose that one over other ones. What 5 years
Yes.
ago? What was a 26-year-old Nick thinking?
Yeah, you can know my age now. What was going through my head, based on everything we've talked about, then I wanted something that was which was diversified, but probably more importantly, equally weighted. So I didn't want to have too much exposure to one region over another. So if the US makes up 55% of the global economy, I wanted a 55% weighting to the US. Same with the UK, Japan, you know, Asia, South America, all those sorts of things. And it ticked all those boxes, which quite a few on Vanguard don't do, which I think is one of the not traps, but one things that people go into not knowing that some aren't appropriately weighted if you want an equal spread. After that, quite simply, it had a really, really low cost. And I'm sure you've talked about it on your podcast before, but the one thing that can eat into your returns is high costs, which obviously things like stock picking do. They have quite high costs associated to it. So had incredibly low cost to it. It was spread over. Not only was it spread evenly across geographies, it had a really good weighting by sector. So tech, finance, all the different industries you'd want in there. I think that's about it. Really, it just did everything that I wanted it to do. It could be better, and we'll talk about other different funds in a second, but. Overall, it was the best solution for the situation I was in at the time, and still is now, I guess.
Yeah, no, that sounds interesting. I guess to talk about my one then, and then we can compare the two. So I've used the FTSE Global All Cap, which I also talk quite a lot about on Instagram, and also do portfolio updates on YouTube. And I have essentially 100% of my money in my stocks and shares ISA in the FTSE Global All Cap. Um, that also is a global fund. I've been using it for about 3.5 years now since I started investing. I guess slowly over time, I've been upping my contributions. So the reasons why I pick that are essentially the exact reasons why you mentioned, really, because it's essentially proportionally weighted to how much each country makes up of the global stock market. So the UK is 4% of the global stock market. The FTSE Global All Cap has 4% UK stocks. So it's perfectly weighted like that. And similar with your fund, VWRL, as different countries and industries and companies grow and contract over time, that'll be then reflected in the global fund. But the three probably extra things for me of why I chose the all cap. First one is because it also includes small cap stocks. It only makes up about 10% of the fund, but I guess I think you can't guess which country or industry or company is going to perform best. I also think you can't guess which size of company is going to perform best. Large cap stocks, obviously killing it at the moment, especially in the US. But over the next 50 years, there could be some decades where small cap stocks outperform. Who knows? The second reason is that because I'm using Vanguard like yourself, with index funds, you can buy fractional shares. So when I first started it 3.5 years ago, I was still at uni and just put in £100 a month. And that whole £100 would be invested. And then the third one is also because the all cap has an accumulation version, just so that essentially means all the dividends are going to be automatically reinvested rather than receiving cash, and then I guess investing them manually. So I guess, yeah. Any thoughts on sort of those 3 points and how they sort of differ to VWRL?
Yeah, so this might sound like an odd thing to say, but I actually think for the majority of investors, if they want to follow a global style of investing, not that I give financial advice or anything like that, that it's probably the go-to for most starter investors. The reason why, and you touched on it in your second 2 points, is that the fund you can buy fractional shares. So with VWRL, I can't do that. I can only buy one share at a time. So shares are now £91. We'll see how it opens tomorrow. So if you're not investing at least £90, which is a lot of money for people that start investing, it's not going to be that great for you because you're going to be saving up to buy one share and all sorts of things. So global all cap is absolutely fantastic for that, where you can buy as much as you want. You want to buy a fiver's worth, 2 grand's worth, it'll all go in.
Yeah, it's probably worth saying
Um,
here actually quickly as well. There are some platforms where you can buy fractional shares in ETFs, but Vanguard, unfortunately, you can't buy fractional shares with ETFs, but you can buy fractional shares with index funds. And VWRL is an ETF, FTSE Global All Cap is an index fund. So that's sort of the slight nuance there. But yeah, sorry to interrupt, Nick.
Yeah, no. So no, to that point, so I think it's a go-to for most investors. So when people say, "Oh, Nick, I've watched your YouTube channel. I can see that you invest in VWRL. Do you think this is right for me?" And again, I think you've got to be careful because if you're only looking to invest £20 a month, you're going to be saving up for 5 months before you even buy
Yeah,
one single share.
yeah.
So I actually don't think that would be good for them because they're going to be kept out of the market for a very, very long time. Equally, I think the fact that the dividends are reinvested automatically is a massive bonus. I would actually love to have an accumulating version of VWRL with Vanguard, but they just don't offer one.
Mm.
So I haven't got that. I haven't got that benefit to rely on. The one thing that I think we will debate around, so that I'll give credit to Global All Cap for all those things. The reason why I don't pick Global All Cap is it's slightly more expensive. So I think the way Vanguard works is they have a very clear fee. When you log in, you'll see that it charges 0.22% or 0.23. That's what most people will see. The one thing that people don't realize about Vanguard is there are some hidden fees behind the scene, and I don't want people to worry by going, "Oh my god, there's hidden fees I didn't know about." They are incredibly small. So if I benchmark VWRL versus Global All Cap, I think the total cost, including hidden fees for VWRL, is about 0.42% or 43, where Global All Cap is 0.53 or something like that. So it's 0.1% more expensive. And that's, as Global All Cap's slightly more costly for me, because I do invest quite a lot of money each month. I'm buying, 8, 9, 10, 11 shares of VWRL at one go. I don't need to have the fractional option, and I wanted to cut out that 0.1%. So my trade-off of saving that 0.1% of fees is that I don't get the broad spectrum of small cap companies coming through, but I'm banking on the fact that the savings I get in costs are outweighing any overperformance that small cap companies might make. So the only danger of that is I might miss out on companies like Tesla earlier on in their journey. So obviously they wouldn't get picked up in my fund before they got into, say, the S&P 500 or something like that.
Yeah.
So you will have, in your fund, will have performed better maybe because your fund picked up Tesla a lot sooner than my fund did. But they're the small nuances
Yeah,
anyway.
and then as you sort of mentioned, that could then be offset by the 0.05, 0.1% extra cost from the transaction fees that you don't see, but still, I guess, get charged through the fund. So, I mean, ultimately, we are talking here about very, very minuscule things. We're not trying to put people off either of these funds, but hopefully, yeah, I think that's quite a good comparison, though, to be honest with you. I do agree with those things that you said.
Yeah.
And I think ultimately then just probably comes down to, I think the big question between those two funds is whether you want to invest into small caps. If you do, then, and assuming you're using Vanguard's platform, if you do want to invest into small cap companies, then the all cap wins because it includes small caps.
Yeah.
But then if you don't want to, then obviously VWRL wins. And I guess it then comes down to sort of minor differences between, some people actually, I know some people actually like having their dividends received as income, so they actually know how much they're getting. Like they know they're getting
Yeah.
£5 every quarter or £10 every year. Whereas with accumulation funds, it can be a bit more difficult, I guess, to work that out. So yeah, it is quite a nuanced conversation. I think there are very small differences. I think ultimately, as you sort of said, they're both good options, and they're probably the two main global funds that I think people use and people talk about. I know, particularly in the UK scene, I think Americans usually stick to American specific funds, but I think in the UK we're probably more global investors, and they're the two options. But I think for me, yeah, probably the biggest thing was probably the fractional shares, and I know that I can just say at the moment I'm putting in £650 per month, which has slowly increased over time. And I know all of that is going to be invested. Whereas if I was using VWRL, as you mentioned, it's £90 per share. So I sort of need to work out how much I can put in. And I guess it's slightly not as automated as I would like it to be.
No, it wouldn't be. You'd have it. So for me, I'll have 20, 30, £40 just sat there in cash in my account, which does irk me a little bit, but that's the trade off I make.
Yeah. Was there any other global funds you think is worth mentioning? I know obviously the life strategy funds are quite popular on Vanguard, as are the target date retirement funds. We won't get, I guess, too into it, but
No,
do you have
so
any sort of brief thoughts on those? Because I know
yeah,
I always get questions on those, probably like yourself.
yeah, life strategy. I think I've talked about it on my channel before. I think the methodology is fantastic. I think the fantastic products for people who literally have no clue about investing kind of go for it. The biggest problem I have with a Life Strategy 100 fund is it has a really high weighting to the UK.
Agreed.
I can't remember the exact figures, but I think it has probably 4 times the amount of exposure that it should have.
Yeah, I think it's
And
about
all the
18-20% UK, where
Yeah,
it should
it's
be.
4 or 5 times
Yeah, it's
higher or something
crazy.
like that. So, and you might think, oh, Nick, you're not that patriotic. I'm not. I actually think that the UK economy, sadly, I'm not saying it can't do fantastically well in the future. It's just when you compare it to the US and the innovation we've seen over there compared to the UK, I have no confidence that the UK is going to outperform in the future. I was laughing. I was speaking the other day, and it's like sat down with somebody. I was thinking, what is the biggest tech startup to come out of the UK? And I think the biggest one we could find was OnlyFans. That's the biggest one we could think of. And I don't know if I should be saddened or proud of that. I really don't know.
Great British culture, that is.
Yeah, I know, but then again, that's me trying to think that I know more of the market. I'm walking away from the fact that even though I think the UK potentially is useless in the future, I'm still not stupid enough to then go, I'm going to bet more on the UK or bet less on the UK. I'm kind of going, the market will do its thing. I'm going to sit back and I'm going to use my time to invest in other things that I think will be more beneficial to me in the long term.
Yeah, no, that sounds good. And I think just one extra point on that before we then wrap up this episode. The FTSE 100, I think the FTSE 250, the FTSE all share in the UK are slightly more diversified. There's maybe a few more sort of smaller tech companies, but I know the FTSE 100 is made up of a lot of aging, old school companies like oil and gas, banks, high street shops, miners, like sin stocks, like tobacco companies, alcohol companies, and obviously the way that the world's going. People are favouring, yeah, it's more like sort of tech driven, environmentally friendly driven. And I think the UK is only made up, I think the FTSE 100 is about 2% tech stocks, whereas if you're
Yeah.
looking at sort of global fund, you're looking at sort of 20-25% tech stocks, I think.
Very high dividend though. There'll be
Yeah,
some
yeah.
massive dividend pays in there. So if you want dividends or you kind of if that floats your boat, I think UK stocks are actually fantastic for people maybe later in their journey. If I'm honest, yeah, when it comes to ESG, which is all about ethical investing, I think I don't think the UK does terribly well.
And that's sort of one more extra point as well here is that I know Vanguard also do offer some ESG global funds. So I think if people want to a more maybe want to invest ethically or into environmentally friendly companies that are trying to do well for society, you can also find global funds that are ESG. Just look out for that. But that's obviously once
Whoa.
again another
That is a
separate
big
topic.
debate. I've got to say,
Yeah.
I've got a lot of strong feelings on ESG, but that's another
Yeah,
time.
it's how companies are screened. Like, is that the whole thing? Essentially, how they're screened, and they might not actually be ESG, but they're then included in the fund.
Yeah, as I'll say, if you've got an ESG fund, the last thing I'll say is if you've got an ESG fund, it's still got Nestle in, then I think you need to have a good hard think about what you're doing.
That's some homework for people to do. Go and research Nestle and why it shouldn't be in ESG funds.
Yeah.
But no, Nick, thank you very much for joining me on this episode. I hope people have found it useful going through global funds and the one we specifically used. It'll also be on YouTube, hopefully. So if people have been watching on YouTube, hopefully you've enjoyed it as well. I know people can find you at Nick JM on YouTube. Is there anything you want to mention at the end? Anything you want to plug? Any social media stuff?
No, as I'll say, I'm on the normals, YouTube, Instagram. I've got some very interesting content coming out in January, all on stock picking, which you might be thinking, hang on, this guy's just slated stock picking. Why is he going to be doing it? So they'll have to find out, I guess. Come over to my YouTube channel, Nick JM.
And also, everyone, look out for Nick in the press at some point soon.
Yeah, yeah. I was in the Telegraph, which we were talking about before this episode. Got a little bit of abuse for that, and then
Yeah.
iNews is the one that's coming out in 2 days. So I'm gonna have to be one of those people that has "as seen" in there. You know, the banner on the YouTube channel is like "as seen" on the BBC and stuff like that. I'm gonna have to do one of them. But
Yeah, if the article is out, which I think it will be by the time this goes live, I'll link it in like the description and stuff as well, so people can watch that and see Nick's face all over the press.
yeah, he's got everything: his salary, my full name. So yeah, oh well, one of
Inside
those
scoop.
things.
Gonna
Yeah,
get
that's it.
cancelled.
No, but thanks, Amy Ryan. I really
Yeah.
appreciate it.
Cheers for joining me, Nick, and thank you to everyone for listening. Really appreciate it.